All right.
All righty. Okay. So again, when you come in over here to the left, top left, it says positions, and this is just going to give you all the different markets that you're in. Okay, everybody good? All right. Before now, when you get into when you first open your account, you're not going to have any positions. Okay. So you see this box at the top here where it says find a symbol. This little box right up here at the top. So that's where you would type a symbol like we have down here. Okay. And with ThinkorSwim, you noticed a little / that's in front of all. There has to be a / there. Okay. And we'll talk about the symbols in a little bit, but just so you know, the first one I have here, that is the symbol for soybeans. The second one is treasury bonds. The third one is silver. The fourth is gold. And the fifth is crude oil. Okay. So what I can see from this page, if I just look at the crude oil, the bottom one, the CLF 25. All right, right next to it, you see is 67.17. And then next to that, it says minus 0.03. What that means is the price of crude, that the 67.17 is the price of that contract right now.
Okay.
And the number next to that means it's down 3 cents.
So neither of those numbers are the point value or?
No, not for the option. This is for the commodities contract. This is the price of the underlying, the commodity. Okay. So that's the information you can get there. If you slide over to where it says PL day amount or $. So it was showing I'm down $10. You see the negative 10. So in crude oil, I'm down $10 today in dollar amount. Now the next column, PL open dollar amount. Okay, that is since I put those positions on and they've been open, that's where I stand in terms of profit and loss in dollar, in a dollar representation. Okay. Net lick, we'll talk about that later. BP effect, we'll talk about that later, but we'll start right here. Okay. So now if I want to look at and please stop me. If anybody's got a question, stop me. Okay. So if I want to look at my open positions in crude oil, because right now this is just showing me the different markets that I'm in. So I would just click on that CLF 25 and my positions in crude oil would pop up. And here's all of those positions right here. Okay. Now, a couple things just so you kind of understand what's going on here. You see the little red triangles over here to the far left?
Yeah.
Okay. The red triangle means you are short. Okay. And so you can see I'm short in all of these positions. So I got red triangle in all of these crude oils. You can also tell that you're short by your quantity. The next number you're going to see is quantity, and see how it's listed as a negative number, -2, -2, -2. Okay. Right next to the triangle. Okay. So again, if you're short, if you sold the option, it's going to show as a negative in terms of your quantity. Okay. So those two things between the red triangle and the negative number in your quantity is going to denote that you are short. You have sold the option and not bought it. And I'll show you, I've got a couple in gold that I bought. Okay, you see the difference here? We've got green triangles. Those are options I've bought. And then you notice my quantity is a +4 and a +1. Okay, and you'll also notice those are the only two I'm losing money on the buy side. And I bought them for a specific reason, and we'll talk about that later. It's kind of I bought it kind of as insurance on a position, but that's beyond what we're talking about today. But that just gives you the difference between being short and being long in these options. All right. All right. So if we go across here, we see the first column here is mark. Okay. Remember I was telling you about crude oil is $1,000 a point? Okay. So as you can see here, like this very first one, it's the mark. Mark means the market price of that option. And let's look at what this option is. This is a CLF 25. December 16th is the expiration date, and it's got 9 days left. You see that? And it's a 47 put. That's my strike price. Okay, so it's all laid out right there. In the commodities world, so the CL is crude oil. That designates we're into crude oil. Okay, don't ask me why. That's what it is. Crude oil is CL. The F. Does anybody want to take a guess what the F stands for?
Fall.
Nope. That would make more sense. It stands for January. Why? I can't tell you. Okay. The third letter is the month code. So the first two are the commodity. The third one is the month, and it goes from F to Z in December. And not every letter is used, obviously. Okay. So this would be called the January crude contract. And then the numbers at the back, 25, that's for 2025. So this is the January 2025 crude oil contract. Okay. And before I get to the columns, let me just jump up a little bit. You see the big letters right up here, CLF 25 right here. And you can read underneath light sweet crude oil futures. So that's the market that we're looking at right now. If you go over here to the right, you see these bigger numbers, the 67.17 minus 3 cents. That is the futures contract, the commodity contract. It's not the option. That's the underlying. Okay. And that's the price of the underlying right now, the 67.17. And then you see this big sell and buy buttons right here. Do not ever touch those. What'll happen if you do, remember I talked about you could get a futures contract and you could buy it or sell it? That's what happens with those two buttons. We don't want to be in a futures contract. Okay. We want to be in an options contract. All right. All right. So let's go back to this top one here. It's a CLF 25. It expires December 16th. It's 9 days away, and it's a 47 put. We slide across here and you see 0.01. That's the market price of that option. It's worth 1 cent, which is $1,000 a point is $10. Okay, that's all that's worth. Okay, and we'll come back to that in a second. But right now, that option is worth 1 cent or $10. I have two of them. You see my quantity is -2. Okay. And then if you slide across 3 or 4 columns, you'll see a column called net lick. Net lick is $20 because I have two at $10. Okay. And what net lick means is net liquidity. So what that means is if I had to buy that back today, if I had to go in there and get out of that position, buy it back, it would cost me $20 because that's the value of that option today. Okay. Or those two options rather. So mark change is just what's happened today. Is it up or down for the day? Right now, everything's pretty much zero because the market's closed. All right. And this P&L day dollar amount, that's whether, if the market, whatever movement is happening in the market, I'm either going to be making money or losing money a little bit on each option. Again, today it's just all zeroed out, excuse me. Now, P&L open dollar amount. Okay, so open meaning since I put that position on, that's how much profit I've made. So right now you're seeing $700 on that first one. Okay. And then you have the net lick of $20. Now, if we go over to the trade price, you see that next one there?
Mhm.
All right, so you see what it says? It's 0.36. Okay, so that was the value that I received when I sold this contract. How much is 0.36 in crude oil? $360. I did two of them. So if you look at the cost column, $720. Now, there's parentheses around the cost. Okay, well, because most investors buy, right? And so there's a cost. Well, this is the opposite of a cost. That's the reason for the parentheses. This is not a cost. This is actually a credit. The $720 I received as a credit when I put this position on. Okay. And then finally, if you go over to the next column over, the PL open percentage, you can see I'm up 97.22% on that trade. And all that basically is I sold them for 36. They're worth 1 cent, still that $20. So the difference between what I received, $720 versus what they're worth if I had to buy them back of $20, that makes my profit 97.2%. Or in terms of dollar amount, my profit is $700 on that trade right now.
You said to get out of it, it would be the $20.
$20 to get out of it. Yeah, so what would happen is if I want to get out, it's going to cost me $20. I'm going to actually have to pay that to get out of that position, but I collected $720. So I keep the 700, and then I'm out of the position. Okay. Theoretically, 9 days, could the thing go haywire? And, this is a 47 put, it's sitting at 67. So could price of crude oil drop $20 in the next 9 days? It could. I mean, anything's possible. Chances are it won't, but it could. All right. So you can kind of look, if you scroll down just a little bit to where you see the bottom of the screen there. So you take a look at the column with all the parentheses around them, the what do they call that? The cost column. And you can see at the bottom, collected $20,500 on those crude oil contracts. Okay, now they were sold at different times. And then right now, the total net lick, if I had to buy all my positions back in crude oil, would cost me $3,320 to buy those back, which leaves me sitting right now at a profit of $17,180. Okay. All right. Now, one other thing I want to point out here. If we go back over to this list of different strike prices, all the different strikes on the left where the triangles are. Okay. You look at the top 1, 2, 3, 4, 5, 6, 7, 8. The top 8 are expiring in 9 days. Okay. So those are going to be gone in 9 days. Then I have a group that are 69 days till expiration. See those? I got about three strikes there. And then I have, looks like the rest of them are 100 days till expiration. Okay. And that's the way that, okay, go, question. Okay, 90 days, is that what you said? Yeah, okay. So we sell options at the 90-day mark. That's what we like to do. So all of these were sold at 90 days. And it's just time has passed since then they were sold. Okay, so the ones at the bottom are 100 days. When I say 90, sometimes it's 104 days, it's 108 days, it's
Because you
89.
said on Fridays.
Yeah, it just depends on when it expires and when I'm getting in the trade, but it's roughly in the 90-day range is when I'm selling them. Does that answer your question? Okay.
Is there a limit, just really quick, is there, so you know how some of them expire in 9 days? Is there a limit on like, once the expiration date gets to a certain amount, like, could you enter a trade with 5 days left in it, or?
You could.
Or is that
You
not
could.
smart to do, or is that like, what is that?
So, well, let's look at these ones up here at 9 days. They're worth 1 cent all the way down. Every single one of those 9-day options is worth 1 cent. So do you really want to take that risk and get $10? That's what you'd be receiving,
Okay.
right? So it just doesn't make sense. And the problem is you can buy 30-day options, 40-day options, but the problem is you have to get closer to the money to get a decent premium. Because remember, all we're selling is time value. So the smaller that time value, the smaller the value of that option is going to be.
Oh, so 45 days ago, when you were in this, they were worth more than.
Oh, yeah. Oh, yeah.
Oh, so that changes as.
Every day.
Okay.
Every day it shrinks unless the market moves against that position, then it could rise in value. But time value is shrinking every day. Okay. All right. Does this all make sense so far?
Mhm.
And stop me if it doesn't.
It's making sense, I'm just saying.
Okay.
You gotta do it more than one time.
Yeah.
Yeah. So what we're doing basically is on a daily basis, I just look at the market and I'm looking to see what's available out there. I look at things that tell me fundamental data about crude oil. What's going on in crude oil right now? Is something in the Middle East heating up that might cause the crude oil to move? I'm just kind of checking this stuff out. And then I'm looking at what's available, how much can I make? And a point that we haven't covered yet is a situation called margin. Okay.
Okay, so I think when I was opening my account, that's what I was.
It's a margin account is what they call it.
Yeah.
All right. So I don't know if you've all ever heard this in the stock market, there's a term called buying on margin. So you can literally buy more stock than the money you have in your account. It's a loan, basically. You're buying on margin. It's a loan.
Don't want to
Okay.
do that.
Well, you can't in the commodities market. It does not exist. Commodities
is
market
on-
is a cash game.
This is on what? You said you can do it.
Oh, no, stocks.
Stop. Oh, okay.
Stock market. But commodities market is no dice on that. Now they do have something though that's called margin. And what margin is, every trade you make, when they put that money into your account and you sell an option and that money goes into your account, they also are smart enough to know that, think about that for a minute. If every trade I made, they put money in my account, what's to stop me from just trading 24/7 and dumping hundreds of thousands of dollars in my account?
That would be like money laundering.
Yeah, well, what's going to stop me? Because they know, we've assumed the risk on all those trades, right? So they want to make sure you have enough money in your account to guarantee that trade, basically. So what they're going to do when they go ahead and put that money in your account, but then they're going to take a little deposit called a margin deposit, and they're going to slide it to the side, and it's going to sit there. It never leaves your account, but you can't withdraw it. You can't use it. It's just sitting there to guarantee that trade. And so that way we have to be very conscious of how much margin we've used in our account. That's one of the things that we monitor all the time. If I go back here to positions and get all my total positions here, and I look across here, you see this column right here, BP effect. That's essentially margin. And what that stands for is buying power effect. So as you can see, they're holding $54,216 in margin on my account to cover all the trades I have in all these markets. It's just set aside. Okay. And what we do is we basically look at that amount versus the cash amount in the account. And we don't ever want to go above 50% margin versus cash. And I'd really rather you be in 40% range.
40% margin, say it again.
40% BP, which is BP effect divided by cash.
So is it once that, it expires, that margin is then
It's
released
released
back into your account?
Yep.
They just hold it for the duration of that.
Exactly. Or if I buy that option back, because I can buy them back early.
Mhm.
So if I want to buy it back, they'll release that margin back to my account as well.
Mhm.
Okay. All right. Everybody cool with that? All right. So real quickly, I'm just going to go through this. We'll go back
I
to,
did have a question.
yeah.
And this is probably opinion. So do you think, like, once Trump comes in, that that's gonna affect the market?
Oh, I'm sure it will. Yeah. Now,
So what are they
it'll affect the
expecting?
stock market more than it'll affect the commodities market.
Right.
Because commodities, stocks have a tendency that they can be manipulated. You know, you
Mhm.
see
Mhm.
Elon Musk makes a tweet and all of a sudden the price goes up or
Yeah.
down. Well,
Mhm.
his tweet's not going to affect soybeans. I mean,
Mhm.
price of soybeans is the price of soybeans. So there's much less manipulation that goes
Now,
on.
what we always hear, and this might not be true, like the price of oil
Mhm.
going down because there's a storm somewhere else. Is that
Yeah, it's affected by 1,001 things.
okay?
And I do think I think part of the reason we can, let's see, we're at oil. If you scroll down here below the oil positions, you see that this is a chart.
Mhm.
You see how that price has been coming down? Okay. And I think, Trump's always talked about drill, baby, drill, and we're going to do all that sort of stuff. So I think that's pulling the price of oil down somewhat. I think that's part of it anyway. So, but to answer that question, yeah. Okay. Okay, so if I wanted to place a trade in crude oil, I'm just going to run through this real quick. Okay. I want to place a trade in crude oil. I would go just up above here where it says option chain right here.
Mhm.
What do we do with these two buttons over here?
Yeah, they don't take them.
Don't ever touch them. And I think I just actually did.
Ooh.
No, it doesn't happen until I confirm it.
Okay, I'm good.
There goes Tom's account. All right, so we're going to click on the option chain.
Yeah.
All right, now you see all of these different options here, and you can look at them and you can see how many days left till expiration on all of them. Can you guys read that? It's kind of small.
Mhm.
39 days, 69 days, 100, 130, 159. We can go all the way out here to 1,074 days left till expiration. Okay. Don't do that though. We want to be in that 90-day range. Okay. So if you see these little red triangles here, this basically, and there's one up here, or up here. That means I have positions in those months.
Mhm.
So here's the ones with 9 days left. Here's the one with 69 days left. Here's the one at 100. Okay. So if I want to see what's available in this 100-day category, which expires March 17th of next year, I'm just going to click on that and it's going to open up what's called an option chain. Okay. And just real quick, how to read this. Right here in the middle, this gray bar is the strike price. Yep, 64 and a half, 65, on and on. Okay. So those are the strike prices. The call options are on the left side. The put options are on the right side. Okay. And you see where the background changes from black to kind of gray and gray to black here. Okay. This line that separates the two is essentially where this price is today. So that's at the money. That line represents at the money. All right. So if we want to do a put option, we want to be below the money. So if it's 67, we want to be 66, 65, 64. We want to be below the money on a put. And if we want to do a call, we want to be above the money, 68, 69, so forth. So if you just remember, we want to stay in these black quads of this thing. Okay. All right. Now you can just scroll, you know, and go further and further away from the money. Or the easiest way is right up here where it says strike. We change that to delta. We haven't gone over this, but just for your, you know, if you want to play with this once you get yours opened, you change that to delta and you change where it says 50 there, you just put 5 and hit enter.
What does delta mean?
Delta is how much change the option is going to make versus every dollar the underlying moves.
Okay, just like you said, the point.
Right. Every change in this is going to change. It's not going to change by the same amount though. So the delta is how much this changes versus this.
Is
The
it
higher
still
the delta,
1,000?
the higher the delta, it's still 1,000 in points, but the move is going to be much less. We want a low delta because it's going to move less versus the movement here. Okay, so we generally go around a 5 delta in that neighborhood.
Yeah.
All right, and so when I clicked on the 5 delta, if you look what popped up here, we got 3 triangles here. So those are positions I have open in my account right now. Okay. And just want to take a look at a couple things here real quick because I know we're getting short on time. All right, so let's the call options are again on the left, the put options are on the right. All of them in a 0.5 delta. So if I look at this, say this 91.5 strike price, do you see that? And I slide all the way out to the left, it's showing this number 95.92%. All right, and this column is probability that this option is going to be out of the money, OTM, at expiration, prob OTM. Okay, we want that to be 93% or higher. That's what we're looking for, is we don't want to take a trade that has a less of a chance than 93% that it'll expire out of the money. So we want to be very, very safe, very, very far out of the money, very conservative. All right, and this one is a 95.92. It's even better yet. All right.
The higher the percentage would be the lower amount that you're getting.
That's true. That's true. They're kind of on a sliding scale because the further away you are, the more chance it's going to expire worthless. So buyer's not going to be willing to pay as much money for that. All right. But we're trying to find that happy medium. Okay. The next column here is open interest. This means this is how many contracts are outstanding in that strike price right now. So there's 338 buyers out there and 338 sellers that have come together and done this particular contract, us being one of those. All right. There's the delta, 0.05. All right. And then if you come across a little further, you see bid and ask. All right. So our bid number is 0.23. Our ask number is 0.25. So we got a little bit of a spread there.
Really quick,
Yep.
just to go back, the second column, are we?
Open interest?
To judge anything, like how one has 1791?
Great question. Great question. Yeah, I'm sorry, I skipped over that. We want a decent amount of open interest. There's no minimum number, but if you look at it, we've got one down here with 45, 95, and then like Savannah just said, there's one to 1791. Okay. Now this one is still 95.45% probability out of the money. It's a 0.6 delta, but that's okay. That's not terrible. And then my bid and my ask. Now look at the spread on that. 25 to 56. That's a bigger spread.
Mhm.
All right. I have a rule pretty much in crude oil. I want to collect at least $300 on a crude oil trade that I put in per contract. So as I'm kind of searching through here, I'm not seeing any that are 30 cents on the bid right now. Everything is below 30 cents. So I'm probably not going to place a trade in this spot right here because of that.
Mhm.
Why would so many people want such a big spread like that? Is that
Well,
attractive
it's-
to some, like,
Well, there's two things at work here. So the spread will widen if the market gets real volatile. If the market's moving up and down fast, the spread will widen out. But what this is 99% in the aftermarket hours when there's no trading going on, sometimes the spread shows up wider.
Hmm.
And then you go in when the market opens and it'll be right back to where it normally is. But for whatever reason, in the aftermarket hours, sometimes that spread widens up. It's no,
Cause it can't change.
doesn't mean anything necessarily. You want to look at it though when the market's open. So this, I probably wouldn't do anything here with crude oil just for that reason, because I want to, so you got to remember, you are taking on risk when you do these, right? Well, let me show you one more thing. Let's just say if I did want to buy, we'll just go up here to that one with 1,700 open interest, that 90, that's a 90 call. So all I got to do is click on the bid number and this little box opens up.
Mhm.
It's already populated to sell it because I clicked the bid. So see the sell right here? I can change my quantity to whatever I want. It's going to tell me what the market is here. It's already comes populated. It's expiration on March 17th, 100 days out, a 90 call. You can kind of read across there. And then here's the bid. Here's the ask. Okay. I can change that price. If I don't think I want to do 20, 25, 26 cents. I'm going to go up here at 39 cents. I can do that. I can change that price. Okay. And then limit order is really the only choice we have in the commodities market. It's a limit order. Day order just means this order would be good until the close of business today. That's what all that means. Now, once I get this what I want here, I can click review. All right. So if I sold two of these, I would collect $775.50. Everybody see that? And that's my 780 is my gross minus $4.50 in fees. So I'd collect a net of 775.50. And then you see this buying power effect over here, the 1505. That's what they're holding, sliding aside in my account to hold to guarantee that trade. So if everything else looks good on the option chain and we think this is a good trade, we go to this point where we're reviewing it and we're going to take our credit 775 and divide it into the BP effect of 1505. That's going to give us, in this case, 51%. Okay, 0.51. We don't want to do any trade that's less than 20%. 51 is a great trade. 20% is the minimum that we want to get. And all we're doing is saying, they're holding $1,500. I want to make sure I'm getting enough to make it worthwhile to set that $1,500 aside. So if they were holding $1,500 and I'm only going to collect $150, not a good trade. Not anything I want to do. But that's our final check to see if this is a good trade or not. Okay. And you guys can, you'll have this recording so you can review all that. Now, I don't want to send this order, so I would just delete it right here. If I did want to send it, I'd hit this white send button and it would send off to the market. Okay. Okay. So I know I threw a lot of stuff at you here today. Any questions about any of this with the platform, with any of the concepts we talked about, anything?
I'm sure there will be.
Had to work being manipulative, so I want to make sure apparently I set up my account right with insurance. So, this is right.
Right. Okay, so you got